Welcome back to the deep dive. Today we're diving into some of your research on using option strategies with leveraged ETFs to generate passive income.
Sounds interesting.
Specifically, you've been looking at SOXL, TQQQ, ETHU, and IBIT, and it looks like you're interested in selling puts and covered calls.
Yes.
Now, before we get into the nitty-gritty, I have to ask, what is it about these specific ETFs that caught your eye?
Well, what's fascinating about these ETFs is their potential for amplified returns, especially when combined with option strategies.
Okay.
They're all designed to multiply the daily returns of their underlying indexes.
Right.
SOXL and TQQQ are both 3x leveraged. ETHU is 2x leveraged.
Okay.
And while IBIT isn't technically leveraged, it tracks the notoriously volatile Bitcoin.
Yeah, Bitcoin's crazy.
This amplified movement can create opportunities for higher premiums when selling options, which is what piqued your interest,
Right, exactly. But I'm also aware that leverage magnifies losses, and I don't want to end up in a situation where a small market dip wipes out my entire investment.
Yeah, I hear you.
So I'm trying to understand how options can help me mitigate that risk while still taking advantage of the potential for those juicier premiums.
That's a smart approach, and you're right to be cautious.
Okay.
Remember, the leverage factor in these ETFs is reset daily.
Oh, right. Yeah.
This means that even in a seemingly flat market, you could experience unexpected losses due to the compounding effects of daily gains and losses.
Really?
For example, let's say you're interested in TQQQ, which tracks the NASDAQ 100.
Okay.
Imagine the NASDAQ jumps 5% one day, then drops 5% the next. An investor in a regular NASDAQ 100 ETF would be back where they started.
Right.
But with TQQQ's 3x leverage, that seemingly flat market could actually lead to a net loss.
Oh, wow. So even though the market's flat, I could still lose money.
Exactly. And option strategies can help you navigate that volatility
Okay.
by providing a way to potentially generate income while managing your risk exposure more effectively.
That makes sense.
So you're not just at the mercy of those daily swings.
Okay. I think I'm starting to understand how those daily resets could impact my returns.
Sure.
And it definitely highlights the importance of risk management.
For sure.
But before we dive into the specifics of selling puts and covered calls, can you remind me of the basic mechanics of each strategy?
Of course.
I want to make sure I'm fully prepared to analyze these ETFs through that lens.
Absolutely. Let's start with selling puts.
Okay.
Imagine you're acting as an insurance provider for someone who owns shares of SOXL.
Yeah.
They're worried about the price dropping, so they pay you a premium for the right to sell you 100 shares at a predetermined price.
Okay.
The strike price.
Right.
Before a certain date, the expiration date.
Got it.
If the price of SOXL stays above that strike price, the option expires worthless. You keep the premium, and you don't have to buy any shares.
Okay.
But if the price drops below the strike price, they might exercise their right to sell you those shares at the agreed-upon price. So you're essentially betting that the price won't drop significantly, and you're getting paid for taking that risk.
Right. So selling puts is a bit like saying, I'm willing to buy this ETF at this price, and I'm getting paid for the possibility that I might have to.
Exactly.
Now, what about covered calls? How does that strategy differ?
Think of covered calls as renting out your ETF shares.
Okay.
You already own 100 shares of, let's say, ETHU.
Right.
By selling a covered call, you're giving someone the right to buy those shares from you at a specific price.
Okay.
Again, the strike price.
Right.
Before the expiration date.
Got it.
In return, you receive a premium, which is like rent.
Okay.
If the price stays below the strike price, you keep your shares and the premium. But if ETH's price goes above the strike price, they might exercise their right to buy your shares at that price, potentially limiting your potential profit if the price keeps rising.
So, in a way, both strategies involve taking on a certain level of obligation in exchange for an upfront premium.
That's right.
And the key is to strike a balance between generating income from those premiums and managing the potential risks associated with those obligations.
Yes.
I'm seeing how this can get complex quickly, especially when you factor in the amplified gains and losses of leveraged ETFs.
You're absolutely right. It's like walking a tightrope.
Yeah.
You need to be aware of both the potential rewards and the potential pitfalls.
So how do we even begin to apply these strategies to the specific ETFs I'm interested in? Let's pull up that table from my research, which compares SOXL, TQQQ, ETHU, and IBIT side by side.
Sounds good.
Where do we even begin with something like SOXL, which is tied to the notoriously volatile semiconductor industry?
Let's start there, with SOXL being 3x leveraged to the ICE semiconductor index.
Yeah.
You've got a recipe for some serious price swings.
Yeah.
What are your initial thoughts on applying these strategies to such a volatile ETF?
Well, my gut reaction is that selling puts on SOXL could be risky given its potential for sharp drops.
I see.
But I'm wondering if selling covered calls might be a way to capitalize on those price swings while still limiting my risk.
Okay.
Of course, I don't want to limit my profits if the semiconductor sector suddenly booms. How do we find that balance?
That's a great question, and it leads us to the crucial aspect of strike price selection.
Okay.
Choosing the right strike price is a balancing act, especially with a leveraged ETF like SOXL.
Gotcha.
Let's break down how to approach this for both selling puts and covered calls.
Sounds good. I'm all ears. Okay, so let's talk strike price selection.
Right?
When selling puts on SOXL, we're essentially saying we're willing to buy it at a certain price.
Right.
Given its volatility, how do we choose a strike price that balances potential profit with the risk of getting assigned shares we might not want?
That's where your research and understanding of the semiconductor sector come into play.
Okay.
Let's say SOXL is currently trading at $30.
Yeah.
If you're extremely bullish and believe the price is unlikely to drop significantly, you might consider selling an in-the-money put with a strike price above $30.
Okay.
This would give you a higher premium,
Right.
but also increase the chance of being assigned shares.
So if I'm more cautious, I should aim for an out-of-the-money put with a strike price below $30.
Exactly.
That way I'd receive a lower premium but have a larger buffer before having to buy the shares.
You're catching on quickly.
Thanks.
The key is to find a strike price that aligns with your risk tolerance and market outlook.
Okay.
If you're comfortable owning SOXL at a slightly lower price,
Yeah.
selling an in-the-money put could be a way to maximize premium income.
But if I'm primarily focused on generating income and want to minimize the risk of assignment,
Right.
an out-of-the-money put might be a better fit.
Exactly.
Okay, that makes sense for selling puts.
Good.
But how does strike price selection work when selling covered calls on SOXL?
When selling covered calls, you're capping your potential upside.
Right.
So if you choose a strike price too close to the current price, you might miss out on significant gains if SOXL rallies.
Oh, I see.
On the other hand, a higher strike price will offer a lower premium.
So it's a trade-off between premium income and potential share appreciation. If I'm bullish on semiconductors in the long term, it seems like I'd want to choose a higher strike price to allow for more upside potential.
That's a good point. It all depends on your outlook for the underlying sector and your desired risk-reward balance.
Okay.
Let me ask you this. What's your general sentiment about the semiconductor industry right now?
Well, I'm cautiously optimistic.
Okay.
I think there's potential for growth, but I'm also aware of the cyclical nature of the industry and the potential for pullbacks.
I see.
So I don't want to be too greedy.
In that case, you might consider selling a covered call on SOXL with a strike price that's slightly above the current market price.
Okay.
This would give you some room for upside potential while still generating a decent premium.
Right.
But remember, if SOXL breaks out and surges past your strike price,
Yeah.
you'll have to sell your shares, potentially missing out on additional profits.
Gotcha. So there's always a trade-off.
Exactly.
Okay. I'm seeing how strike price selection is crucial for tailoring these strategies to my outlook and risk tolerance.
Yes. It's all about finding the right balance for you.
But SOXL is just one piece of the puzzle.
Right.
Let's shift gears and talk about TQQQ, which tracks the tech-heavy NASDAQ 100.
Okay.
What are the key considerations when selling puts and covered calls on TQQQ?
With TQQQ, you're essentially betting on the performance of tech giants like Apple, Microsoft, and Amazon.
Right, some of the biggest companies in the world.
It's also 3x leveraged. So those daily resets and compounding effects we discussed earlier are still very much in play.
Right, and the tech sector can be just as volatile, if not more so, than semiconductors.
That's true.
So I imagine strike price selection is equally important here?
Absolutely.
Would we follow a similar approach as with SOXL?
The principles are the same,
Okay.
but the specific factors you consider might differ.
Like what?
For example, when selling puts on TQQQ,
Uh-huh.
you'd want to factor in things like interest rate hikes,
Right.
inflation concerns, and the overall health of the tech sector.
Yeah, that makes sense.
Are you concerned about a potential tech bubble?
Hmm.
Or do you think these companies are poised for continued growth?
I think there are definitely some headwinds facing the tech sector,
I see.
but I'm still bullish on the long-term potential of these companies.
Okay.
So maybe a slightly out-of-the-money put would make sense, giving me some downside protection while still offering a reasonable premium.
That sounds like a prudent approach.
Thanks.
And what about covered calls on TQQQ?
Yeah.
How comfortable are you with potentially selling your shares if the tech sector takes off?
That's a tough one.
Yeah, it's a balancing act.
I'm torn between wanting to capture the upside potential and generating income from premiums.
I understand.
Perhaps choosing a strike price that's further out of the money would make sense here, giving the price more room to run before my shares get called away.
That's a good way to balance those competing desires.
Right.
Remember, you can always adjust your strategy as market conditions change.
That's reassuring.
Now let's move on to ETHU, which is 2x leverage to the price of Ethereum.
Okay.
What stands out to you about this ETF and how it might fit into your options strategy?
Well, I know that cryptocurrencies can be incredibly volatile.
For sure.
And even with 2x leverage, ETHU has the potential for massive price swings.
Absolutely.
Honestly, I'm a bit hesitant to sell puts on ETHU.
Okay, why is that?
Because even a seemingly safe strike price could be breached quickly if the crypto market takes a downturn.
You're right to be cautious with ETHU.
Yep.
It's a different beast compared to SOXL and TQQQ.
Yeah.
The crypto market operates on its own unique dynamics.
Right.
And those daily resets can be amplified even further by the inherent volatility of Ethereum.
So if I were to consider selling puts on ETHU,
Yes.
I'd need to be extremely selective with my strike price and prepared for the possibility of significant losses.
That's right.
What about covered calls? Would that be a less risky approach?
Selling covered calls on ETH could be a way to benefit from its volatility while still owning the underlying asset.
Right.
However, you need to be mindful of the potential for sudden price spikes.
I see.
If Ethereum experiences a major rally, your shares could be called away at a price that's far below its true market value.
Okay, so even with covered calls, risk management is paramount.
Absolutely.
Perhaps choosing a strike price that's significantly out of the money would be the most prudent approach,
Okay.
allowing for some price appreciation while still collecting premiums.
That's a reasonable strategy, especially if you believe in the long-term potential of Ethereum.
Right.
Now let's wrap up our ETF analysis with IBIT,
Okay.
which tracks the price of Bitcoin.
Got it.
Even though it's not leveraged, Bitcoin is still known for its wild price swings.
Yeah, no kidding.
How does that factor into your thinking about options strategies?
Well, even without leverage, IBIT is still exposed to the unpredictable nature of the crypto market.
It is.
I'm hesitant to sell puts because I don't want to be forced to buy Bitcoin at a price that's significantly higher than the market value. Covered calls might be more appealing, but I'd need to be careful not to limit my potential gains if Bitcoin suddenly surges.
You're thinking along the right lines. With IBIT, strike price selection is just as crucial as with the leveraged ETFs.
Okay.
Even though the amplification factor isn't there,
Right.
you'll need to carefully consider your outlook for Bitcoin and your willingness to potentially sell your shares.
This deep dive has been incredibly helpful in understanding how to approach these 4 ETFs with different option strategies.
Good. I'm glad to hear that.
But I'm realizing that strike price selection is just one piece of the puzzle.
It is.
What are some other techniques I can use to effectively manage my risk when using options with these volatile ETFs?
Risk management is absolutely essential when dealing with leveraged ETFs and options.
Yeah, I'm starting to see that.
There are several techniques you can use to protect your capital and avoid costly mistakes.
I'm eager to learn more. Let's dive into those risk management strategies. We've covered a lot of ground discussing strike price selection for puts and covered calls on SOXL, TQQQ, ETHU, and IBIT.
We have.
But I know there's more to managing risk than just choosing the right strike price.
Right.
What other techniques should I have in my arsenal when dealing with these potentially volatile ETFs?
One of the most powerful tools you have is the stop-loss order.
Okay.
It's essentially an automated safety net that helps you limit potential losses by automatically closing your position if the ETF's price moves against you.
So if I'm selling puts on ETH,
Right.
and I'm worried about a sudden drop in the price of Ethereum,
Yeah.
I could set a stop loss order to buy back the puts if ETHU falls below a certain level.
Exactly.
That way, I wouldn't be stuck with an obligation to buy shares at a much higher price than the market value.
That's a great example. Stop-loss orders can be particularly helpful when dealing with leveraged ETFs because those price swings can happen so quickly.
Right, makes sense.
It takes the emotion out of trading and helps you stick to your risk management plan, even when things get turbulent.
Okay, so stop-loss orders are like a safety net to prevent catastrophic losses.
Exactly.
What other risk management techniques should I be thinking about?
Another important concept is position sizing.
Okay.
This is all about determining the appropriate amount of capital to allocate to each trade.
Right. So how much money I'm actually putting on the line.
You don't want to overextend yourself, especially when dealing with leveraged ETFs.
Right. Even if I'm incredibly bullish on TQQQ, I shouldn't bet my entire portfolio on it.
No, definitely not.
Especially considering it's 3x leverage.
That's right.
How do I determine the right position size for these types of trades?
There are a few different approaches to position sizing.
Oh,
One common method is to risk only a small percentage of your total portfolio on any single trade.
Okay.
Maybe 1% or 2%.
Right.
That way, even if a trade goes against you, it won't wipe out your entire account.
That makes sense. I'd also imagine that diversification plays a role in risk management.
Absolutely. Diversification is key to spreading your risk and protecting your portfolio from being overly exposed to any single asset or sector.
Right. Don't put all your eggs in one basket, as the saying goes.
Exactly. In this case, you're already diversifying.
Okay.
By considering 4 different ETFs.
Right.
SOXL, TQQQ, ETHU, and IBIT.
Gotcha.
Which span different sectors and asset classes.
That's reassuring. Are there any specific strategies for diversifying within my options trades themselves?
You could consider combining different option strategies.
Okay.
Which is often referred to as a risk reversal strategy.
It's reversal strategy.
For example, you could sell a covered call on TQQQ while simultaneously buying a put option on the same ETF.
Okay, interesting.
This would limit your potential upside on the covered call.
Right.
But provide downside protection with the put option.
So it's like hedging my bets.
Exactly.
I'm limiting my potential gains on one side, but protecting myself from potential losses on the other.
That's the idea.
I'm starting to see how these different risk management techniques can work together to create a more balanced approach.
That's exactly it. And remember, risk management isn't a one-time setup.
Oh, right. Okay.
It requires ongoing monitoring and adjustment.
So it's an ongoing process.
Yes, you'll need to stay informed about market conditions, news events, and any factors that might impact the ETFs you're trading.
Makes sense. So I can't just set it and forget it.
Exactly. Don't be afraid to adjust your stop-loss orders, position sizes, or even exit a trade entirely if your outlook changes.
So it's not just about picking the right strategies at the beginning. It's about staying engaged and adapting as the market evolves.
That's right.
Now, before we wrap up this deep dive, I want to touch on the tax implications of selling puts and covered calls.
Okay.
I know that options can have unique tax treatments.
You're right. Taxes are an important consideration.
Yeah, for sure.
The good news is that in most cases, profits from selling puts and covered calls are treated as capital gains.
Okay.
Just like when you sell stocks.
So if I sell a covered call on SOXL and my shares are called away, I'd report that profit as a capital gain on my tax return.
Exactly. However, there are some nuances to be aware of.
Okay, like what?
For example, the holding period of the option.
Okay.
And in the case of covered calls, the underlying shares can affect how those gains are taxed.
Right.
Short-term gains,
Yeah.
which apply to assets held for less than a year, are taxed at your ordinary income tax rate.
Okay.
While long-term gains for assets held for more than a year are typically taxed at a lower rate.
Gotcha.
So if you're looking to minimize your tax burden, holding on to those options and shares for longer than a year could be advantageous.
Okay, that makes sense. Are there any other tax-related wrinkles I should be aware of when it comes to options?
There are a few other things to keep in mind. For example, if you exercise a call option to buy shares of an ETF, the price you paid for the option becomes part of your cost basis for those shares.
Okay.
This will affect your capital gains or losses when you eventually sell the shares.
So those options premiums aren't just disappearing into the ether, they're factored into my overall cost basis.
Exactly.
I'm realizing that the tax implications of options can be quite nuanced.
They can be, and it's always a good idea to consult with a qualified tax professional.
Yeah, that's probably a good idea.
To ensure you're handling everything correctly. And taking advantage of any available deductions or credits.
That's great advice. I've learned so much during this deep dive.
Good, I'm glad.
We've explored the potential of selling puts and covered calls on leveraged ETFs.
Right.
Examined the risks involved. And discovered various techniques for managing those risks effectively.
It's all about finding the right balance for you.
We even delved into the tax considerations.
We did.
What are your key takeaways for listeners who are considering these strategies?
My main takeaway is that option strategies with leveraged ETFs can be powerful tools for generating income.
Okay.
And potentially amplifying returns.
Right.
But they require careful planning, diligent risk management, and a thorough understanding of the underlying assets.
I completely agree. It's not about getting rich quick.
No, it's not.
It's about making informed decisions,
Right.
managing risk,
Absolutely.
and staying engaged in the market.
Couldn't have said better myself.
And as you mentioned, it's always wise to seek guidance from a tax professional to ensure you're on the right track.
For sure.
And that wraps up our deep dive into option strategies with leveraged ETFs.
Thanks for having me.
As always, we encourage you to continue your research, explore the resources in our show notes, and reach out if you have any questions.
Great advice.
Thanks for joining us on The Deep Dive.